We're Company 3 in World 14, Management 497. Our presentation is broken down as follows. First, I will be talking to you about our executive team. Then we have the industry performance analysis, goals and objectives, our strategy section, which covers both our corporate and functional strategies, the financial statements, achievements and mistakes, and lastly, the future of Paris. So to begin, our executive team was made up of myself, William Imperial. I was the CEO. Douglas Porter was our CFO. Christopher Perez was our Chief Investment Officer. Shakay Samolsi was our Comptroller and President of Marketing. Under her was Tina Rostami, our accountant. And lastly, we had Audrina Shamazarians, who was our Chief Production Officer and also Chief Accountant.
Hi, my name is Christopher Perez, and I will be covering the industry performance analysis. We're going to be covering a few segments of the industry, including net income, return on assets, return on equity, stock price, market share, and unit production cost. The market in itself was very volatile. We never really established a pattern, and neither really did any of the other teams, so we're just going to go ahead and look at how our company did, beginning with net income. Our return on assets has also remained solid throughout the years, with the exception of the very few first couple of years, but that was due to the creation of our plant in Sereno, which tied up a lot of our cash, so it brought down our return on assets momentarily. Ever since then, however, our return on assets has been above average. It has risen from an average of 1.37 to an average of 2.12. And as you can see at the very end of year 6, we finished in third place behind 2 of the other companies. Return on equity has also maintained itself above the industry average and has not been very volatile. A lack of movement in our securities has meant that there hasn't been various changes in our stock price and then therefore our return on equity. One of the things that helped our return on equity in the last couple of years was also the repurchasing of some of our stock, which helped our average raise, as you can see at the very end of year 6. Our stock price has also been pretty solid throughout the years that we've been here. Our stock price did, however, take a dip in year 5 due to a stock out that we encountered. Naturally, investors panicked, and therefore our stock price dropped. Another thing that affected our stock price was the other companies repurchasing their stock prices. We eventually followed suit, and as you can see, that served us very well because at the end of year 6, our stock price rose a great amount. One of the things that we were very pleased with was our unit production cost. Our unit production cost has stayed well below the industry average. One of the things we're most pleased with is that our unit production cost now, which is 421, is actually lower than what we began with at 436. We are also very pleased with the fact that although our unit production cost is low, we are still capable of producing high quality products in Miracle One. Market share has been pretty parallel with the industry average. We're hoping for much more improvement in the coming years to follow. Net income is something that we can be very proud of. Although it was very volatile throughout the years, we were happy to see a stable growth in the entire year 6. This was due mainly to our sales force, which we could contribute most of these sales to. And we were very pleased to see the results, and we hope that they continue in this pattern throughout the following years.
Adrina, I am speaking about goals and objectives. This section is divided into subsections: weighted factor result and the financial goals and results. This table shows Paris' final weighted factor result and the scores after all companies were graded. Although Paris was unable to achieve high score in each area, Paris was able to receive an A on our most heavily weighted factor, with a score of 92.42%. Our unit production cost was an average of $4.58 for year 3 through 6. Paris was also to generated the third highest net income. 3 of the 7 goals were achieved, which are marked in green, while the remaining were not. Paris was able to achieve both net income goals by the end of the year 5. Paris exceeds expectation by $282,000, making $1.4 million in year 5, and made $2.4 million rather than the $1.9 million in year 6. Lastly, we did succeed in achieving the last financial goal, as our unit production cost was $4.02 per unit in year 6, quarter 3.
We have our corporate strategy, our business and competitive strategy, and lastly, our functional strategies. I will be talking to you about both the first two, both our planned and emergent strategies, and the functional strategies. I will talk to you about marketing, Audrina will talk to you about production, and Tina will talk to you about finance. Didn't change too much from our 2-year plan. It remained internal expansion. The reason being is because our weighting factors kind of dictated the strategy that we chose to implement. If we had followed a different strategy like retrenchment, it would have just been counter to our most heavily weighted factors, which were market share and unit production cost. Some of the ways, although not traditional, that we internally expanded and grew pairs was through our increased sales force. We added 2 new production lines, and we also offered a wide-ranging product line. We used a hybrid approach. In all areas except America 1, we chose to be the low-cost provider. And in America 1, we used broad differentiation strategy. Now, there were 2 main reasons we did this. In year 4, we had very low market share in America 1. And after conducting market research, we found that the products that they liked were high-quality, high-featured products. So we knew that was going to increase our costs in America 1. So we couldn't really be the low-cost provider in that area. It was just impossible. We had a lot on market share, and we had to get that up. Production was broken down into the 3 areas that we have control over: marketing, production, and finance. I'll be discussing marketing, Audrina will be discussing production, and Tina will be discussing the finance. In terms of marketing and our pricing, we didn't really deviate from our plan. We did increase prices slightly, about 5 cents in America 2 and America 3, and about 10 cents in America 1. But we did keep our prices relatively the same. Sereno, we increased our prices quite significantly, primarily because we had market share and we had those loyal customers where even if we increased prices more, they still continue to buy. Our market share didn't change in that area. We did change our plan. We initially were going to use pulsing strategy, meaning that whenever we released a new model, we would increase advertising and then reduce it in subsequent quarters. But rather, we used continuous advertising, and essentially we would increase advertising during high demand sales seasons and then keep it consistent for the next quarter, the low demand season, and then raise it again in the other high demand season. So it continuously increased, which caused our advertising expenses to increase significantly more than we anticipated. Salespeople that Paris employed increased from year 4 to the end of year 6 by 4. However, we did hire more than that, but due to normal attrition rates and other various factors, we did lose some of the employees that we had. But it seemed to stabilize once we increased our salaries and commissions.
This slide shows our planned and actual research and development expenses. The brown color represents our planned expense and the gray color represents the actual expense. As you see in year 5, first, second, third quarter, we spend more than the planned. However, we only able to release 2 new models instead of 3. In year 6, we only spent 5,000 less than our planned one. Those are our planned and actual training expenses. The brown color represents our planned training expense and the gray represents the actual one. In year 6, we spent more than our planned. Paris training costs were to remain relatively high and stable. This was due to the fact that Paris wanted to lower our unit production costs through the year 5 and 6.
I'm going to talk about Paris financial strategy. And for Paris bonds, there is no change and it remains the same. And it is 1,900. The shares reduced by 1,500 and now it is 4,500. Our ending cash is 4.1 million and there is no bank loans or time CDs for this company.
Hey, my name is Shaka and I'm going to talk about the financial statements, the comparing of our 2-year plan and actual year 6. Because we, in 2-year plan, we're forecasting to have more sales rather than the actual year 6 that we had. That's why we came up with some major differences in income statement and also in balance sheet. Like we see, we have more taxes that we paid in year 6 forecasting rather than our actual year 6 because with more sales we have more taxes. And in our operating expenses we can see that sales commission and transportation expenses is also 2 major differences in our income statement. We know that by increasing the commission we can have more sales. That's why in year 6 we increase our commission for salesperson to have more sales. And about the transportation expense, because in America 1 and 2 we need more inventory, that's why our transportation expense goes up from Serena and America 3. About the foreign currency adjustment, we can say that we had variance of exchange rate in year 6, and that's why we came up with 216% differences. Also, in balance sheet, we can see other differences that came up, cash balance and taxes payable. In 2-year plan, we have more cash balance because we projected to have more sales, and with more sales we can get more money. But in year 6 we experiencing less sales, and that's why we had less cash balance. And also taxes payable, because we had more sales, that's why we had more taxes payable in 2-year plan, but in year 6 we had less taxes payable. That's why we came up with negative 62% differences. Thank you so much.
Hello, my name is is Douglas Porter. I am going to be covering the achievements and mistakes of Paris Incorporated. One of the great achievements we made was our unit production cost. Being able to drop the unit production cost significantly. And another great improvement we made was our net income. We tripled our net income in the years we managed the corporation. And our return on equity did very well also. So the pricing in America 1 was one of our mistakes, that we were trying to avoid a stock out, and we raised the price significantly, and that was a terrible mistake that affected our market share for the remainder of the game. And the other mistake we should have realized in the beginning of the game, to increase our return on equity, we should have started our stock buyback program earlier in the game. And we also had several stock outs that we really should have been more on top of. We had a couple of problems in year 5 and 6. We had 2 stock outs in year 5 and 1 in year 6. And we came up with a solution of creating 2 new lines that stabilized our production level, and we had no more problems since. And the other thing that was a great mistake was the stock repurchasing we initiated too late. We should have started it much earlier in the game. And we also didn't utilize our cash properly. We should have invested the cash on a regular basis.
It's an exciting time at the Paris Corporation, exceeding $25 million in gross sales the past year and accumulating a net income of $2.4 million. Paris forecasts a bright future ahead and will undoubtedly remain a fierce competitor. The current management team has begun making strategic alliances to eliminate Company 5. Year 7 will be a year of major change and expansion, particularly when it comes to production. Taking advantage of the current and forecasted exchange rates, 2 new plant additions will be added to our existing Sereno plant. While most of our production will be sent overseas, our America plant will still be producing most of our products. In fact, Paris America plant will be operating at full capacity by year 7, quarter 2, as a new line will be created. Paris will be significantly increasing production for year 8 and 9. Management's focus for year 7 will shift from year 6, emphasis on gross sales, to production. During year 7, our training program will increase dramatically, which will be an effort to increase our profit margins. Years 8 and 9 will be dedicated increasing gross sales. Paris will maintain its low prices and purchase market research prior to every model release. Our sales force team in each area will expand to 15, and management's emphasis will be on increasing net income.